When you buy a single share in a company, you're not just placing a bet on a number going up, you're actually becoming a tiny part owner of that business. You're entering into something that looks surprisingly like a relationship, and just like any relationship, you want it to be healthy, long-lasting, and built on more than just attraction. There's no crystal ball that tells you exactly which stock is about to take off. Anyone online promising that is selling you a fantasy. But there are real, practical ways to stack the odds in your favor, the same way you'd actually get to know someone before deciding to commit. Let's walk through exactly what that looks like. Most beginner investors do the equivalent of falling for someone after a single great first date. They hear a stock mentioned somewhere, a friend, a headline, a video, and they buy in purely on excitement. No background check, no real understanding of what they're actually getting into, just vibes. And just like rushing into a relationship without knowing someone's history, this usually ends one of two ways. It either works out by pure luck or it ends in regret. There are two broad approaches people take when picking stocks. The first is technical analysis, reading charts and price patterns to try to predict short-term movement. This is mostly used by day traders, and the honest truth is that the vast majority of day traders lose money rather than make it over time. It's less investing, more guessing with extra steps. The second approach is fundamental analysis, actually getting to know the company, its financial health, its leadership, its competitive position. This won't make you rich overnight, and if that's what you're after, this video probably isn't for you. But for anyone serious about building wealth over years rather than days, this is where the real edge lives. Let's actually do this together using a real company, Microsoft. Step 1. Check their financial profile. Before getting serious with anyone, you'd want a sense of their financial stability. For a company, that's the balance sheet, a snapshot of what they own and what they owe at a specific point in time. Microsoft's most recent reported figures show total current assets of roughly $159.7 billion and total current liabilities of around $125.3 billion. To check whether a company can comfortably cover its short-term obligations, you divide current assets by current liabilities. For Microsoft, that comes out to approximately 1.27. A ratio above 1 generally means a company has more short-term assets than short-term debts, a healthy sign. Microsoft has $1.27 in assets for every $1 of liabilities due within the year. That's a company that isn't living paycheck to paycheck. Step 2. Look at their track record. This is where the income statement comes in, essentially a report card showing how much money a company made and spent over a set period. For its full fiscal year 2025, Microsoft reported total revenue of $281.7 billion and net income, what's left after every expense, of $101.8 billion. To check profitability, you divide operating income by total revenue and multiply by 100. Microsoft's operating income for the year was $128.5 billion, which works out to a profit margin of roughly 45%. As a general guide, 5% is considered a low margin, 10% is healthy, and 20% is considered high. Microsoft's margin is more than double what's typically considered a strong result. That's not a company barely staying afloat. That's one operating with serious efficiency. But, and this matters, a great track record doesn't guarantee a great future. Plenty of once dominant companies have coasted on reputation while quietly losing ground. Past performance is information, not a promise. Step 3. Check their wallet, the cash flow statement. This shows money moving in and out across 3 categories: operating activities, investing activities, and financing activities. Operating activities should generally be positive, meaning the core business brings in more cash than it spends running day to day. Investing activities are often negative for healthy growing companies, because a negative number there usually just means they're reinvesting into equipment, infrastructure, or acquisitions. Exactly what you'd want to see from a company still expanding. Financing activities show whether a company is taking on debt responsibly or relying on dividends it can't actually afford. If a company is borrowing heavily while still paying out large dividends with weak cash flow, that's a red flag, the equivalent of someone who just lost their job but keeps buying expensive gifts to keep up appearances. Here's where it gets interesting, because the numbers alone don't tell the whole story. Just like meeting someone in person after a great-looking dating profile, sometimes a company looks perfect on paper, but something doesn't add up when you look closer. This is where qualitative analysis comes in, examining the things spreadsheets can't capture. Brand recognition is the first piece. Ask people on the street what they think of Microsoft, and most will mention Windows, Office, or Xbox without hesitation. That kind of widespread trust acts as a buffer against competition. Customers don't switch away easily from something deeply embedded in their daily life and work. Leadership is the second piece. Microsoft's CEO, Satya Nadella, has led the company since 2014, over a decade of consistent direction. Long tenure at the top often correlates with deeper institutional knowledge and more stable long-term strategy, though it's never a guarantee on its own. Competitive advantage is the third piece. Microsoft's position in cloud computing through Azure, alongside its dominant position in workplace software, gives it a moat that's difficult for competitors to cross. These advantages are like gold for investors. They tend to mean lower risk and a more durable business over time. None of this shows up in a balance sheet, but all of it shapes whether a company keeps winning 5 or 10 years from now. There's one more psychological trap worth naming here. Panic selling on bad news. When a scandal or a bad headline breaks, the instinctive reaction is to dump the stock immediately, the same way someone might end a relationship over a rumor without ever checking if it's true, but markets overreact to news constantly. The investors who do well over decades are usually the ones who did their homework up front, trust that research, and don't get rattled by every headline. So, how do you actually put this into practice? First, decide which kind of stocks fit your strategy. Value stocks are typically large, stable, established companies with lower price-to-earnings ratios that often pay dividends. Think consumer staples, utilities, and financial institutions. Growth stocks, by contrast, tend to reinvest profits instead of paying dividends, trade at higher valuations, and are expected to expand faster than the market. Companies like the ones leading in cloud computing or artificial intelligence often fall into this category. Second, never bet everything on one relationship. A common guideline is to avoid putting more than roughly 5% of your portfolio into a single stock, and no more than about 20% into any one sector. Spread your investments across multiple sectors and multiple companies, so that one disappointment doesn't sink your entire plan. Third, do your research before committing, not after. Check the balance sheet for financial stability. Check the income statement for a track record of profitability. Check the cash flow statement to see how money actually moves through the business. Then check the qualitative side, brand strength, leadership, and competitive advantage. Fourth, decide in advance when you'd actually sell, and make sure those reasons are about your life, not the news cycle. A genuine financial emergency, hitting a personal financial goal, or a real change in the company's fundamentals are valid reasons to sell. A scary headline is usually not. And fifth, if researching individual companies feels like more effort than you want to commit to regularly, that's completely fine. A simple diversified index fund lets you own a small slice of hundreds of companies at once, without needing to run a balance sheet check on each one. Picking a stock and picking a partner have more in common than most people realize. Both reward patience over impulse. Both punish decisions made purely on excitement. And both work out best when you actually take the time to understand what you're committing to before you commit. Microsoft didn't become one of the most valuable companies on earth because of a flashy headline. It got there through consistent revenue growth, strong margins, durable competitive advantages, and leadership that stuck around long enough to execute a strategy. That's not a thrilling story, but it's the kind of story that actually builds wealth. Next time you're tempted to buy a stock because of a hot tip or a trending headline, ask yourself the same question you'd ask before getting serious with someone. Do I actually know what I'm getting into, or am I just excited? And that is a wrap on today's video. If this changed the way you think about picking stocks, hit the like button. It genuinely helps more people find this channel. And if you're not subscribed yet, tap subscribe and hit the bell so you never miss a video. Every single week we break down another money topic just like this one. I'm Mark from Mark the Investor. I'll see you in the next one. Take care.